Welcome back to Organized, the business law breakdown. I'm Professor Seth C. Oranburg, and in this episode, we're diving into why you'd select a limited liability company as your corporate or company vehicle for your business organization. LLCs are the most flexible and customizable business entity available today, and you can even govern them with unusual and new strategies like a decentralized autonomous organization. But before we get ahead of ourselves, let's step back and recognize that LLCs are going to be the most flexible of all the forms, but that doesn't make them the best of all the forms in all the cases. You might think about it like this. If you go to a store and you buy a coat off the rack, it's inexpensive because it's mass produced and it might fit pretty well. On the other hand, if you go to a tailor, you can have them make a coat for you and it might fit amazingly well, but you'll spend a lot more. LLCs are kind of like that custom tailored option. They can be made to measure and designed to fit perfectly, but you need to have someone who's quite good in order to make this in the right way, as opposed to the ease of going and selecting an off-the-shelf option. LLCs have become wildly popular in the United States because they offer the liability protection of a corporation with the flexibility of a partnership, but again, with great flexibility comes complexity. So, as we go through this, you're going to see that the answer is it depends to many aspects of our framework. And the reason to choose this form is you really want to have a mix and match of the other forms we've already discussed. That said, let's jump in. An LLC is a state-created entity that combines the ability to have pass-through taxation like a partnership with the liability shield of a corporation and the potential for management either like a partnership or a corporation. And all this is governed primarily by an operating agreement. An operating agreement is a private contract between the members, and this structure is used by all sorts of businesses, ranging from solo consultants to massive joint ventures. It can be even used for investment funds. And in fact, this podcast is brought to you by BizLaw LLC, which is a sole member LLC that I own. These are customizable forms, but they're easy to mismanage if you don't know the rules. So let's walk through those rules. And we'll begin with formation. To form an LLC, you must file an Articles of Organization, sometimes called a Certificate of Formation with the state. So these can't be made accidentally like general partnerships. The filing is usually pretty short. It's just the name, address, and a registered agent. Remember that if you form an organization in a state, you need to be able to be sued in that state. You don't have to reside there, but you have to appoint somebody who can physically receive service of process. But the real substance of the formation of an LLC is in the operating agreement, which can be quite lengthy if you have a multi-member LLC, because you have to provide for all the flexible details, like management structure, profit sharing, voting rights, buyout rules, and more. The operating agreement doesn't have to be filed publicly, but without one, you're subject to default rules that are specified in the Limited Liability Company Act of whatever state in which you incorporated, and they may not fit the business purpose that you had intended. So it's important to have an operating agreement in place when you start an LLC, even though it's not a formal requirement of formation. Next, let's talk about liability. All members of an LLC enjoy limited liability, whether or not they manage the day-to-day operations or operate kind of like a board. That means that nobody in the LLC is personally responsible for the debts or obligations of the company. Of course, unless they've signed some kind of personal guarantee, or if the veil is pierced. We can pierce a limited liability company veil like we can pierce a corporate veil. Managers may owe fiduciary duties to the LLC and its members, similar to corporate directors. But the law on LLCs is much newer, and so we don't have quite as robust an understanding of what's the extent of these fiduciary duties and when could they be waived. The liability shield of an LLC is strong, like in a corporation, but it depends on respecting formalities and avoiding commingling personal and business funds. But as a general matter, this is a good form to choose when you want to have limited liability. And it could even function in the same way a limited partnership does without the need for a blocker corporation as the general partner, because none of the members, whether they control it or whether they're passive, have liability for the company's debts. Moving to control rights, LLCs offer two default management models, but again, you can customize them. A member managed LLC is like a partnership where all members participate in day to day decisions, and typically it functions like one person, one vote. A member managed LLC has a designated manager or a group of managers that functions like a board and handles the operations like a corporation does. So we could have something set up flat or hierarchical. Again, it's flexible. Control rights are governed by the operating agreement. So without one, many states assume member management, although some have a check the box where you can pick when you file what type of company you want to make. In general, the default is a member managed company has one person, one vote. It's not about per dollar invested. So they default to being a little bit more like partnerships than they are like corporations. But again, the operating agreement will dictate how it all works. LLCs can even designate non member managers. They offer extraordinary flexibility, but you have to have a good reason for making these unusual choices. I'm just letting you know that they're available. We can also separate control from financial rights in unique ways. So let's talk about financial rights. I mentioned earlier that LLCs are appealing because they're pass through entities. That means that we can tax them like partnerships, which is to say they're not taxed at all. Instead, profits and losses are reported on the members' personal tax returns. There is no corporate level taxation. And this may sound good that there isn't double taxation, but there are some challenges as well, because you might have profits even though you don't have distributions. Distributions is when the company actually gives cash to its members, whereas profits, well, that simply shows that the company made money that year and owes taxes. The situation where the company made profits but the members don't get distributions is called phantom tax. You owe tax on money you didn't receive. And this can be a challenge you want to have addressed in the operating agreement. By default, profits are shared equally. And also, there are equal responsibilities to cough up more cash if there's a capital call. But again, this can all be and should be changed and spelled out in the operating agreement to reflect capital contributions or any other metric that's important for this particular company. Distributions of that cash, again, they're not automatic. So members have to agree that distributions should be made. Or the operating agreement can provide that if there's profits, the company is going to kick out enough cash that the members can cover their tax bill. Moving to continuity of existence, most states treat LLCs as perpetual entities. They are separate from their members. And so if members come and go, that doesn't cause the LLC to dissolve in most states. So members can continue the business after a buyout. Still, the operating agreement should address continuity as well. What happens if someone leaves or dies or wants out? Because without a plan, you can expect disputes. And if there are disputes, then we can end the life of an LLC because it may have to be administratively dissolved if it arrives at deadlock. If they simply can't move forward, the result might be that the LLC has to stop operating and wind up its affairs. Again, the operating agreement can head this off by having an advanced set of protocols for what happens when a member wants to retire or leave, which leads us to liquidity. Liquidity meaning how transferable are the units, the ownership rights. LLCs are generally not very liquid because they're so customized. It's a little bit harder to sell because what a LLC unit means is different for most LLCs. Since they're designed to be flexible, you have to actually take the time and effort to read very carefully what exactly a unit in an LLC entails because it's going to be different for each organization. The whole point of customization is that you have those differences. So they're generally not liquid because they're a little bit hard to understand and because they're not designed to be so transferable in many cases. If you want to have an LLC that you can easily liquidate shares, you might pick a corporation as a form instead because those are designed for liquidity of investment. Financial rights can generally be assigned to others. So if you are entitled to some stream of payments for an LLC, you can probably assign that stream to somebody else, like your nephew, if you want someone to inherit some financial benefit from you. But management rights usually can't be transferred without unanimous consent. Again, the operating agreement can change these rules, but by default, members can't sell their vote or bring in a new manager without buy-in from the rest. Finally, we can talk about mergers. LLCs can merge with other LLCs or with corporations or partnerships. subject to approval by the members, which typically would require unanimous consent unless the agreement says otherwise. And then you'd have to file a certificate of merger with the state. The process is similar to a corporate merger, but it's less standardized across jurisdictions, so it can be difficult to merge LLCs in two different states. And it may not be the type of entity form that an acquirer wants to purchase. So when an LLC has become valuable enough to be an acquisition target, instead of merging as an LLC, often we'll convert them into a C corporation first, and then the C corporation will be purchased in a merger or acquisition process. So the summary on LLCs is that they offer liability protection, flexible management, customizable profit structures, and many potential tax advantages. But they require the most planning and the most precision. Even though they're the most flexible, they may not be the best choice because without a strong operating agreement, members are stuck with default rules that may not reflect their intentions. LLCs are really great for small businesses with single owners because we don't have any of the governance issues. And those agency costs that we have built corporate law to deal with don't apply when the manager and the owner are the same person. Small businesses with multiple owners can also benefit from the LLC form, but this gets a little bit complicated because some may want to distribute profits in order to pay tax bills, and others may want to retain those profits to continue building the business. So that's just one area where there can be disputes that wouldn't arise with a corporation where we have corporate level taxation. LLCs are often used for professional service firms, especially because, as we'll talk about next, there are specialty forms like the PLLC, the Professional Limited Liability Company, or for a joint venture or for a project that would otherwise be a limited partnership. Basically, they're for anyone who wants flexibility and is willing to pay for it. And by that, I mean pay your lawyer for it, because you're going to want a good lawyer to draft a functional operating agreement that defines the terms that you need. So when would you recommend an LLC over a corporation? And what pitfalls might arise if a group skips the operating agreement? Those are the things we want to think about when we process the decision of picking an LLC. Really, it seems like the obvious choice because it's the most flexible. But the point I want to get across is more flexibility doesn't mean better if you don't need the bells and whistles. You might be better off with an off-the-rack solution. So I'd recommend an LLC over a corporation, either when those things don't matter, like a solo who is going to be operating with ownership and control anyway, or if you have a well-defined structure that fits into a already established mode for how LLCs operate, or if you have a good lawyer who can design an operating agreement that meets your needs. Thanks for listening to Organize, the Business Law Breakdown. In our next and final episode of the series, we'll explore those specialized forms, like LLPs, professional corporations, low-profit entities, B Corps, and we'll use that to wrap up our comparison matrix. But until then, remember, law doesn't just regulate business, it organizes it.